Keeping with our series of investing abroad videos, we are back with yet another actionable avenue for you to increase your exposure to international markets. How, you ask? Through fund of funds. Before we reveal all the details, don't forget to subscribe to our YouTube channel. After stopping mutual funds from accepting investments in their international schemes, SEBI has loosened the strings. However, this relaxation comes with a rider. International MF schemes will be allowed to reinvest in stocks of overseas listed companies to the extent of the redemptions and consequent selling of such stocks from 1st Feb 2022. Not all international schemes are able to use these new limits, as international schemes had not seen much redemptions. On the other hand, it has been business as usual for fund of funds investing in overseas listed ETFs. Now, there's a separate $1 billion limit for these funds, and according to industry sources, around $700 to $800 million of this limit remains open. While fund of funds are also MF schemes, there are differences. Here's what you should know. What kind of investments do they offer? An FoF can invest in units of ETFs, index funds, or even other MFs investing in securities listed abroad. Through such ETFs and other index funds, an FoF can offer investment ideas and themes that are not available in the domestic market. For example, Mirai MF has recently launched Mirai Asset Global X Artificial Intelligence ETF FoF and Mirai Asset Global Electric and Autonomous ETF FoF. Now, both these FoFs are investing in units of ETFs that are listed on overseas exchanges and give investors exposure to investment themes like artificial intelligence, EVs, and driverless vehicle technology. Through FoFs, you can also take exposure to US market indices, which is a more suitable avenue for your initial international exposure. For example, Kotak Nasdaq 100 FoF and Aditya Birla Sun Life Nasdaq 100 FoF invest in iShares Nasdaq 100 UCITS ETF. The Nasdaq 100 is an index of the 100 largest US companies listed on the Nasdaq. So for someone looking at much broader US market exposure, Sachin Bansal-backed Navi Mutual Fund recently launched US Total Stock Market FoF, which invests in an ETF run by Vanguard, the US asset management firm that is the pioneer of passive investing. Then you also have Vanguard Total Stock Market Index Fund ETF, which tracks the CRSP US Total Market Index, a broad US index that covers nearly all of the US equity market across multiple sectors and comprises more than 4,000 stocks. So what about the fee? According to SEBI regulations, FoFs can charge up to double the total expense ratio of the underlying ETF, subject to a maximum limit of 1%. For example, if the TER of the ETF is 40 basis points, the FoF can charge 80 bips. But if the TER of the ETF is 60 basis points, the FoF cannot charge 120 basis points, as the maximum limit of 1% will apply. Now, as far as taxation goes, like all international schemes, an FoF is treated like a debt investment for taxation purposes. This means to get preferential long-term capital gains tax rate of 20% and indexation benefit, you will have to hold the investments for at least 3 years. If you have capital gains and you withdraw your investments before 3 years, your gains will be treated as short-term capital gains and your income tax slab rates will apply. I'm sure you're wondering how to get started with this investing in FoFs. Do you need a demat account? Well, while a demat account is a must for buying an ETF on domestic exchanges, the good news is you don't need one when buying these ETFs through FoFs. This is because FoF is structured as an open-ended mutual fund scheme that is pooling all investors' money and then deploying it in the ETF or combination of ETFs on your behalf. So complying with KYC requirements are enough to get started with investing in an FoF. The next big question is how much to invest in them. You can allocate money in line with your asset allocation decided on the basis of your financial goals. Do not chase a theme just because it's in the news. If you're a beginner, stick to large cap exposure of developed markets like the US. Invest through SIPs and gradually build your exposure up to 10 to 20% of the desired equity exposure of your portfolio. Hope this gives you a well-rounded view about fund of funds and how it can add global markets exposure to your portfolio. If you have more questions about investing abroad and want us to do a detailed video on any of its aspects, don't forget to drop us a comment.